West Hobart is sitting at $740,000 for a reason. 2 years ago, Hobart corrected hard. Prices fell, investors fled. But here's what's changed. Rental yields hit 3.3 to 3.6%. Vacancy rates compressed to 0.4 to 0.6%. And new infrastructure is on the horizon. The data reveals something really interesting. While most investors were panicking, West Hobart was setting up for recovery. Plus, 4.6 annual growth is already happening. This is a case study in what happens when panic selling creates opportunity. West Hobart is positioned just 2.5 kilometers from Hobart CBD. You can walk to the city in 30 to 35 minutes, drive in 5 to 8 minutes during peak hour, or catch a bus in 10 to 15 minutes with frequent services. The commute is genuinely convenient with no regional commute pain. The vibe is distinctly established inner suburb, mix of Victorian terraces, 1970s family homes, newer apartments, tree-lined streets, and it's walkable to cafes and amenities. The demographic is younger than broader Tasmania, at median age of 38 compared to 42 statewide. The families and young professionals anchoring the market. The median house price sits around $740,000. For context, North Hobart sits at $780,000, so it's only 5% more expensive. Battery Point's, the prestige inner suburb, sits at $1 million plus. Sandy Bay sits at $850,000 plus. West Hobart's $740,000 positioning puts it at entry level for inner Hobart. Not the cheapest, not the prestige priced, but fair value for established inner suburban position. The value story is clear. 2 years ago, after correction, West Hobart was genuinely undervalued. At $740,000 today, it recovered to fair value with real rental demand backing it at 3.3+% yields. The growth story over 5 years has been plus 49.9%, which is strong performance through the 2020 to 2025 cycle. But the recent 12-month growth of 2.4 to 4.6% is the relevant story. Hobart corrected sharply from 2022 to 2024, and West Hobart was part of that. But recovery is accelerating now. November 2025 saw house values rise 0.9% monthly, with a quarterly growth at 2.4% and annual growth at 4.6%. This matters because two specific factors are driving it. First, the rental market tightened dramatically, with vacancy compressed to 0.4 to 0.6%, and rents are up 9% annually. Investors are rushing back because yields hit 3.3 to 3.6%, which is really attractive after correction. Second, there's been a confidence shift. Westpac reported a positive 39.5% surge in purchasing intentions in Tasmania, which is the highest nationally, suggesting mainland migration momentum is real. West Hobart is an accessible inner suburb, is the clear beneficiary of this shift. Let's look at supply and demand. Days on market at 27 to 31 days is fast for inner suburbs. Properties are selling quickly. Over the past 12 months, approximately 58 house sales happened within West Hobart, which is reasonable turnover. What does this signal? Supply isn't constrained artificially. You're seeing genuine demand meeting available stock at fair pricing. The market is functioning healthily, not overheated, not stagnant. This is a balanced market where fundamental value is more important than artificial scarcity. Demand is genuine and accelerating. Rental vacancy is at 0.4 to 0.6%, which is really tight. It signals strong rental demand for West Hobart housing. Rents have grown 9% annually, which means landlords can command premium rents. This creates a compounding effect. High rents equal higher yields equal more investor interest, which in turn equal price appreciation. Additionally, Westpac's positive 39.5% surge in purchasing intentions in Tasmania suggests mainland migration is also real. These are people relocating for lifestyle and affordability. West Hobart is an accessible inner suburb with a 30-minute walk to the CBD. It's exactly where these migrants want to be. Here's the game changer. The Hobart City deal includes a proposed rapid bus network along the Glenorchy to Hobart corridor, and West Hobart sits on this corridor. The proposal includes a dedicated rapid bus service with 10 to 15-minute frequencies, stopping at multiple nodes, including West Hobart. Implementation timeline shows planning phase between 2026 to 2027, with service commencement from 2028 to 2029, which is estimated. Additionally, the Hobart City deal includes medium density housing targets and urban renewal for inner suburbs. West Hobart is identified as part of the Northern Suburbs Transit Corridor activation, meaning tax incentives, planning fast tracking, and amenity investment. These catalysts aren't guaranteed, but they're funded and government backed. Infrastructure is likely being built to make inner suburbs like West Hobart more accessible, and that accessibility equals price re-rating. Houses rent for approximately $600 per week on a $740,000 purchase price. That's 3.6% gross yield. The Hobart average is 4.4%, but context matters. Prestige suburbs like Battery Point and Sandy Bay, their yields are 2.5 to 3%. So West Hobart's 3.6% is actually pretty strong for inner suburb positioning. Units rent for about $550 per week at $600,000, which equals a 3.5% yield. Combined with 4.6% annual growth, total return here is 7.6 to 8.6% annually. That's pretty solid for a suburb Australian real estate. West Hobart attracts both owner-occupiers, which is estimated to be anywhere between 60 to 65% of the market, and investors. The demographic is younger than broader Tasmania, as discussed before. Median age is 38 versus 42 statewide. This means family with children, young professionals, and downsizers all inhabit West Hobart. More importantly, the story here is owner-occupiers want to live here because of CBD proximity and walkable lifestyle, which anchors community stability. Investors want to own here because of tight rental market yields and growth. The dual demand creates price support. West Hobart isn't a speculative suburb. It's a residential suburb where people actually want to live and invest. Goulburn Street Primary is on site as well, with school covering West Hobart. Secondary schools are 2 to 3 kilometers away. For families, schools are anchor values. The broader amenity story here is strong. Hobart is 5 minutes from Salamanca Market Precinct, close to restaurants and cafes, walkable to CBD's shopping and culture. The vibe is family friendly, with young families clearly attracted here. Schools and walkable amenities like West Hobart, desirable for owner-occupiers, which means rental demand and price support. So what are the risks? Interest rate sensitivity here is real. At $740,000, small rate moves impact serviceability. Rising rates could soften demand. Tasmania's economy is also tourist dependent, so economic downturn could impact employment and visitor-driven opportunities. The rapid bus network is planned, but not guaranteed. So if delays stalls, growth catalysts also soften. If Hobart-wide development accelerates, supply could increase faster than demand. Tasmania's aging population trend means without continued interstate migration, growth could also soften. Overall risk is low to medium. The market fundamentals are solid with yield. Rental demand and accessibility is strong, but infrastructure execution and migration patterns will determine the upside here. If you're an investor seeking inner suburb Australian real estate with yields plus growth, Hobart checks the boxes. 3.6% yield plus a 4.6% annual growth, tight rental market, accessible CBD location. If you're a mainland buyer priced out of Sydney and Melbourne seeking Hobart affordability with strong fundamentals, West Hobart is excellent. You get inner suburb positioning at 1/4 the price of inner Sydney or Melbourne. If you're a first-time buyer in Tasmania wanting CBD proximity without premium inner prestige pricing, West Hobart is ideal. If you're seeking pure yield at 5% plus, regional Tasmania like Devonport or Burnie beats West Hobart on yield alone. Timing is also favorable. Hobart's correction from 2022 to 2024 created opportunity. Recovery is now underway. A positive 4.6% annual growth, rental yields at 3.3 to 3.6%, investor purchasing intention surging at 39.5% in Tasmania. The market is in recovery and not yet in hype phase. Over the next 12 to 24 months, as mainland investors discover Hobart's affordability and West Hobart's accessibility, prices will re-rate. The rapid bus network development plan for 2026-2027 will further support this growth narrative. Right now, in January 2026, you're in the informed investor window, after correction, before the hype. Not urgency, but rational timing. For returns, here's what the data suggests. So a conservative scenario, 2% growth plus 3.6% yield equals a 5.6% annual return. What's most likely or a realistic scenario here? A 4 to 5% growth plus a 3.6% yield, which gives you around a 7.6 to 8.6% annually. And let's say upside scenario, if infrastructure and migration continue to accelerate, we may see a 6 to 8% growth plus a 3.6% yield, which gives a 9.6 to 11.6% total annual return. So over 10 years, this turns $740,000 into between $1.4 million or $2 million in realistic scenarios. That's meaningful compound wealth creation. The investment thesis is straightforward here. Inner suburb positioning plus post-correction recovery plus tight rental market plus infrastructure catalysts plus mainland migration momentum, throw in dual income from yield and growth. All factors here are aligned, not because of hype, but because of structural fundamentals. When all factors work together, you get sustained demand. West Hobart isn't speculative. It's a position in an accessible, desirable inner suburb during recovery phase with infrastructure supports. That's the story the data tells. Opportunity in fundamentals, not in hype. Now, if this analysis gave you a framework for understanding inner suburb opportunity during recovery phases like in this video, comment below. Subscribe to InvestDoor for weekly fundamentals. If you want personalized strategy for West Hobart or exploring other Hobart suburbs, book a free strategy call with our team. Link is in the description below. Thank you for watching.